Right now, while you're watching this video, Italy's government debt has crossed 2.9 trillion euros. That's not just a number on a spreadsheet. That's a financial weapon of mass destruction sitting in the heart of Europe, ticking louder every single day. And here's what nobody wants to tell you. When this bomb finally detonates, it won't just destroy Italy. It will trigger a chain reaction that could obliterate the entire European financial system as we know it. Drop a comment right now telling me which European country you think will fall first when this crisis hits. Subscribe and hit that notification bell, because what I'm about to reveal will change how you see the global economy forever. This isn't fear-mongering. This is reality, backed by cold, hard data that financial institutions are desperately trying to downplay. Picture of what's happening in Italy right now. The country's debt-to-GDP ratio stands at approximately 137%. To put that in perspective, that means Italy owes nearly 1.5 times everything its entire economy produces in a year. Every pizza sold, every Ferrari manufactured, every tourist euro spent in Rome, Venice, and Florence combined still isn't enough to cover what Italy owes, and it gets worse. The bank has been the only thing keeping this disaster at bay. For years, they've been buying Italian bonds, artificially suppressing interest rates, and essentially printing money to keep Italy afloat. But that safety net is disappearing. Recent ECB policy shifts mean they're pulling back on these emergency purchases. As of early 2025, the quantitative tightening continues, and Italy is being left to face the markets alone. The element becomes absolutely terrifying. Italian banks hold massive amounts of Italian government debt on their balance sheets. When bond prices fall and yields rise, which is exactly what's happening now, these banks see their assets lose value overnight. UniCredit, Intesa Sanpaolo, and other major Italian financial institutions are sitting on billions in government bonds that are becoming increasingly toxic. If these banks start to wobble, depositors panic. When depositors panic, they withdraw their money. When everyone withdraws at once, you get a classic bank run. But it doesn't stop at Italy's borders. European banks are interconnected like never before. French banks have enormous exposure to Italian debt. German financial institutions have extended credit lines worth hundreds of billions to Italian counterparties. Spanish and Portuguese banks trade with Italian institutions daily. When one major player in this system falls, the shock waves travel at the speed of digital transactions. Within hours, not days, the contagion spreads across the continent. In March 2023 with Silicon Valley Bank and Credit Suisse. Those crises showed us just how quickly confidence can evaporate in modern banking. Credit Suisse, a 167-year-old institution, collapsed in a matter of days once the market lost faith. Now, try to multiply that scenario by the third largest economy in the Eurozone. Italy isn't some regional bank. It's a G7 nation with deep financial ties to every major economy on Earth, already sending warning signals that, honestly, most people aren't really paying attention to. The spread between Italian bonds and German bonds, which is basically the risk premium investors demand to hold Italian debt versus safe German debt, has been widening significantly. As of late 2024 and early 2025, this spread has fluctuated dramatically, sometimes crossing 150 basis points. Every time this spread widens, it means investors are demanding higher returns to compensate for the increased risk of lending to Italy. Higher borrowing costs mean Italy has to dedicate even more of its budget to just paying interest, leaving less for, well, everything else. Think about what that means for ordinary Italians. Less money for healthcare, less money for infrastructure, less money for education, less money for pensions. Italy already has one of the oldest populations in Europe, with a median age over 47 years. These people have paid into the system their entire lives, expecting their pensions to be there. But when the government is spending over 80 billion euros annually just on interest payments, something has to give. And honestly, it won't be the bondholders who take the hit first. It'll be the citizens. Now let's examine the political dimension of this crisis, because really, economics and politics are inseparable in this scenario. Italy has had more than 60 governments since World War II. Political instability is practically written into the country's DNA. Giorgia Meloni's government, which came to power in 2022, faces the impossible task of managing this debt burden while also trying to satisfy voters who are tired of austerity. The coalition is fragile, held together by parties with very different visions for Italy's future. Here's the trap Italy is in. To reduce the debt, they need either dramatic spending cuts or significant tax increases. Both options are political suicide. Cut spending, and you trigger protests, strikes, and social unrest. We've seen this movie before in Greece. Raise taxes, and you strangle what little economic growth Italy manages to generate, pushing the country deeper into recession. Italian GDP growth has been anemic for decades, rarely exceeding 1% annually. You can't grow your way out of debt when your economy barely grows at all. The European Union has its own rules about debt, enshrined in the Stability and Growth Pact, which theoretically limits government debt to 60% of GDP and annual deficits to 3%. Italy violates both of these rules spectacularly, and has for years. The EU has largely looked the other way, because enforcing these rules on Italy would trigger the very crisis everyone is trying to avoid. It's a bizarre standoff where everyone knows the rules are being broken, but nobody wants to be the one to pull the trigger on enforcement. But here's what changed recently. The EU's fiscal rules, which were suspended during the COVID-19 pandemic, have been reinstated with some modifications. Countries like Italy are now supposed to present credible plans to reduce their debt levels gradually. The problem is that credible plans require economic growth, and Italy doesn't have it. The country's productivity has been stagnant for over 2 decades. Italian workers today are barely more productive than they were in the year 2000. That's not a recipe for prosperity, that's a recipe for decline. Let's talk about the second major element of this crisis, the exposure of the European banking system. When I say European banks are interconnected, I'm not speaking metaphorically. The Target 2 system, which is the settlement mechanism for transactions within the Eurozone, shows us exactly how much money flows between these institutions. Italy's Target 2 balance, which represents the cumulative net flow of payments, has swung wildly over the years, sometimes showing that hundreds of billions of euros have effectively left the Italian banking system for safer havens like Germany. This capital flight is a slow-motion bank run. Wealthy Italians and Italian corporations have been quietly moving their money out of Italian banks and into German, Dutch, and Luxembourg banks for years. They see the writing on the wall. They know that if Italy faces a true crisis, there could be capital controls, forced conversions, or even a redenomination of deposits if Italy were ever forced out of the euro. Yes, that's an extreme scenario, but it's one that serious economists and financial planners are gaming out. The derivatives market adds another layer of terrifying complexity to this situation. Credit default swaps on Italian sovereign debt, which are essentially insurance contracts that pay out if Italy defaults, have become increasingly expensive. The CDS market is telling us that the probability of an Italian default, while still not the base case, is no longer negligible. And here's the kicker. Many of the institutions that have sold these credit default swaps are themselves exposed to Italian debt through other channels. If Italy goes down, these institutions face losses on both their direct bond holdings and their derivative positions. It's a double whammy that could wipe out capital buffers in a matter of hours. Let's examine a specific scenario of how this contagion could actually unfold in real time. It starts with a trigger event. Maybe it's a political crisis in Rome, perhaps the coalition government collapses and new elections are called, with populist parties promising to ignore EU fiscal rules entirely. Or maybe it's an external shock, like a global recession that pushes Italy's already weak economy into a deep contraction. Whatever the trigger, Italian bond yields start to spike. Within days, the spread between Italian and German bonds blows out to 300, then 400 basis points. At these levels, Italy's borrowing costs become unsustainable. The government tries to reassure markets, but the statements are vague and unconvincing. International investors start dumping Italian bonds en masse. Prices plummet. Yields soar even higher. Italian banks, which are required to mark their bond holdings to market value, suddenly have to report massive losses. Their stock prices crash. Depositors see the news and panic. The electronic bank run begins. Italian citizens start transferring money to foreign banks or converting euros to other currencies. The European Central Bank faces a choice: intervene massively to support Italian bonds and banks, or let the crisis play out. If they intervene, they risk their own credibility and balance sheet. The ECB's mandate is price stability, not bailing out insolvent governments. If they don't intervene aggressively, Italy faces a full-blown financial collapse. There's no good option, only less bad options. Meanwhile, the contagion is already spreading. French banks, which have tens of billions in exposure to Italy, see their stock prices nosedive. Investors wonder which bank has the most exposure, and in the absence of clear information, they sell everything. Spanish and Portuguese bonds, which investors view as similar to Italian bonds in terms of risk, also get sold off aggressively. Their yields spike. Now Spain and Portugal are facing their own funding crises. The European banking system, which looked stable just weeks earlier, is suddenly in flames. Germany, the economic powerhouse of Europe, faces enormous pressure to bail out the entire system. German taxpayers, who have already contributed hundreds of billions to previous European rescue packages, are furious. Political parties that oppose further bailouts gain traction. The social fabric of Europe starts to tear. Countries that have been allies for decades start pointing fingers. The entire European project, built painstakingly over 70 years, faces an existential threat. Now let's discuss the third critical element: the impact on global markets and the real economy. Italy isn't some isolated economy. It's the 8th largest economy in the world, a major manufacturing power, and a crucial link in global supply chains. When Italy goes into crisis, the effects ripple worldwide. Italian companies that export goods suddenly face higher borrowing costs or complete loss of access to credit. Production slows or stops. Orders get canceled. Workers get laid off. Global supply chains, which are still recovering from the disruptions of the pandemic years, face another massive shock. Companies in Germany that rely on Italian components face production delays. French luxury goods companies that manufacture in Italy see their operations disrupted. The auto industry, which is deeply integrated across Europe, grinds to a halt as parts stop flowing across borders. The economic damage quickly spreads far beyond the financial sector. The euro itself comes under severe pressure. Currency traders, seeing the existential crisis facing the eurozone, start betting against the common currency. The euro plunges against the dollar, the yen, and the Swiss franc. This currency collapse has contradictory effects. On one hand, it makes European exports cheaper and more competitive globally. On the other hand, it makes imports, particularly energy, much more expensive. Europe imports most of its energy. A weak euro means Europeans pay more for gasoline, natural gas, and electricity. Inflation surges, eroding purchasing power and living standards. Central banks outside Europe face their own dilemmas. The Federal Reserve, the Bank of England, and the Bank of Japan all have to decide whether to intervene in currency markets, whether to provide dollar swap lines to European banks that need dollar funding, and whether to cut interest rates to offset the global economic slowdown. The Federal Reserve learned in 2008 that the US financial system is deeply interconnected with Europe. American banks have branches and subsidiaries all over Europe. American money market funds hold European bank debt. When Europe sneezes, America catches a cold. Stock markets around the world enter bear market territory. The S&P 500, which American retirement accounts depend on, drops 30 or 40% as investors flee to safety. The Nikkei in Japan crashes. Emerging market currencies collapse as investors pull money out of risky assets and into US Treasury bonds and gold. Pension funds, which need to generate returns to pay future benefits, see their assets shrink dramatically. Millions of people approaching retirement watch their life savings evaporate. The political consequences globally are profound. Economic crises breed political extremism. We saw this in the 1930s when the Great Depression gave rise to fascism and ultimately World War II. We saw it again in the 2010s when the European debt crisis fueled populist movements across the continent. Brexit, the rise of populist parties in France, Germany, Italy, and elsewhere, all trace their roots in part to the economic hardship and resentment caused by austerity and bailouts. Another major crisis would pour gasoline on these political fires. Let's examine the fourth and final element of this crisis, the potential paths forward and why none of them are easy. In theory, there are several ways Europe could address Italy's debt problem before it explodes. One option is debt restructuring, where Italy's creditors agree to take a haircut, accepting less than full repayment in exchange for making the remaining debt sustainable. Greece did this in 2012, and it was, honestly, enormously painful. Greek bondholders lost over half of their investment. Greek banks, which held tons of Greek bonds, were essentially wiped out and had to be recapitalized by European rescue funds. The problem with this option for Italy is, well, scale. Greece is a small economy, representing about 2% of Eurozone GDP. Italy is roughly 10 times larger. A Greek-style restructuring in Italy would devastate not just Italian banks, but every major financial institution in Europe. The losses would be measured in hundreds of billions of euros. Multiple banks would fail. It would make the 2008 financial crisis look like a warm-up act. No rational policymaker wants to go down this path unless there's absolutely no alternative. Another theoretical option is fiscal integration, where European countries agree to share debt burdens much more than they do now. This could take the form of Eurobonds, where all European countries jointly guarantee debt issued by any member state. Germany has resisted this idea for years, because it essentially means German taxpayers are on the hook for Italian, Spanish, Greek, and Portuguese government spending. From a German perspective, this creates moral hazard, encouraging fiscal irresponsibility in Southern Europe, while forcing thrifty Northern Europeans to pay the bill. There was a small step in this direction with the Next Generation EU Fund, a €750 billion recovery package launched in response to COVID-19. This fund includes some jointly guaranteed debt, which was a major breakthrough. But it's nowhere near large enough to solve Italy's structural debt problem. True fiscal integration would require constitutional-level changes in European treaties, which need unanimous approval from all member states. Getting unanimous approval for anything in Europe is nearly impossible. Getting unanimous approval for something that would cost Germany hundreds of billions is, honestly, just fantasy. A third option is for Italy to inflate away its debt. If you owe a fixed amount of money, and the currency loses value through inflation, your real debt burden decreases. This is why debtors often benefit from inflation, while creditors get hurt. The problem is that Italy doesn't control its own currency. The European Central Bank controls monetary policy for the entire Eurozone. The ECB's primary mandate is price stability, defined as inflation close to but below 2%. They're not going to engineer high inflation just to help Italy with its debt problem, especially when that inflation would hurt German savers and retirees. This brings us to the most extreme option: Italy leaving the euro and returning to the lira. This Italexit scenario has been discussed extensively, especially by Italy's more populist political parties. The theory is that Italy could regain control of monetary policy, devalue its new currency to boost exports, and inflate away its debts. But honestly, the reality would be far more chaotic. The redenomination process alone would be a legal and financial nightmare. Every contract, every bond, every bank account would need to be converted from euros to lira. Lawsuits would proliferate. Capital flight would accelerate to panic levels before the switch could even happen. The new lira would immediately plunge in value, perhaps losing 30 to 50% against the euro and dollar. Imports would become prohibitively expensive. Inflation would surge. Living standards would crater. Italian banks would face runs as depositors tried to get their money out before it was forcibly converted to the new, weaker currency. The banking system would need to be closed for days or weeks while the conversion happened, just like in Cyprus in 2013. Italian citizens would be unable to access their own money. The social unrest would be intense, potentially violent. Moreover, leaving the euro wouldn't actually solve Italy's debt problem. Most of Italy's government debt is governed by international law, not Italian law. Creditors could sue in foreign courts and refuse to accept payment in devalued lira. They could demand euros or dollars. Italy would face either a messy legal battle lasting years or an outright default. Either way, the country would be shut out of international credit markets for a generation, just like Argentina has been after its serial defaults. So if all the potential solutions are terrible, what's actually going to happen? The most likely scenario in the near term is muddling through. The European Central Bank continues to provide just enough support to keep Italy afloat, but not so much that they lose credibility on inflation. Italy makes cosmetic budget adjustments that technically comply with EU rules, but don't actually solve the underlying problem. The debt continues to grow. Interest payments consume an ever larger share of the budget. The economy stagnates. Living standards slowly decline. Young Italians continue to emigrate in search of opportunities elsewhere, draining the country of its most talented and ambitious citizens. This slow-motion decline can continue for years, perhaps even a decade or more. But it can't continue forever. Eventually, some shock, whether economic, political, or geopolitical, will push the system beyond its breaking point. When that happens, all the terrible options we've discussed will be on the table. The question isn't whether this debt bomb will explode. The question is when and how much damage it will cause when it does.